Hello, everyone. Welcome to the Weekly Watch. I'm your host, John Briggs. For our last Weekly Watch of the year, I'm happy to be joined by Paul Robson, our co-head of G10FX strategy. Given the fact that we've had many central bank meetings this week, including the big three of the Fed, ECB, and Bank of England. With all these events, FX markets have been on the move, and it's a good time to get a reset now that these meetings have all passed and kind of set the table for 2023. Paul, I'll review a little bit what happened this week. Say the Fed went 50 basis points as expected. To us, it had some hawkish components to it, but wasn't interpreted as hawkish by the markets. Bank of England just this morning went 50 basis points, less than we expected, but not a major surprise to the market. But the guidance around the bank's expectations was seen as dovish. On the other hand, ECB seems pretty hawkish in regards to their forward forecasts. Lower growth, higher inflation, and Lagarde's tone certainly feels a little bit more aggressive than maybe some people were looking for. So a lot of moving parts here. With all of that said, what do you think was the biggest surprise for you amongst the three?
Well, I think it was very much the ECB, a real sort of hawkish takeaway from particularly the sort of statement in the press conference. You said it yourself. Inflation seemed to be above target all the way through to 2025. That sort of suggests that they will have to do more on policy rates. And Lagarde, pretty much said that. She just said that markets had to price in more for the ECB over this policy cycle. And definitely given the sort of policy guidance over the last couple of months, which seemed to be more on the dovish side, I think this is a hawkish surprise, and it's no surprised to see the euro doing well here. On the Bank of England, less so. I don't think there was a huge amount here. The split vote count maybe leans a little bit dovish. So a couple of people voting for unchanged rates. But if you delve into the minutes, it's a little bit more hawkish. And so the market reaction might need to adjust. So upside surprise to private wage growth, for example, service sector inflation, which we all understand is a little bit more persistent, and even the data have been a little bit stronger than expected. We had some stronger data this week as well, so a bit more balance there. And then the Fed, well, they sounded hawkish, didn't they? Pushing back on financial conditions. I think people sort of expected that, but they saw what they wanted to see, or they want to believe that the Fed pivot is becoming closer.
Yeah, certainly kind of agree with that. But out of all of those three, let's say, and a lot of these divergences, or at least the market seeming to interpret different things from these central banks, is there any particular interpretation or market reaction here after these events that you think is particularly off?
No, I don't think so. I think it's pretty fair. Euro sterling has had a good leg move sort of higher. That reflects that hawkish ECB takeaway, but maybe it will just take a little time for markets to realize that the Bank of England isn't easing off significantly. And the ECB and the Bank of England face a very similar set of drivers, and that's energy prices, it's second round effects, it's wage pressures, tight labor markets. And so I don't think it's really an outcome that suggests that euro sterling should go significantly higher. But generally speaking, the move in the dollar sort of largely as expected, given the tone that we heard from Powell.
All right. So last question, and feel free to take this for whatever time horizon you want. But as we head into 23, let's review some of your views as in the last couple of weeks as we've formulated our year ahead views. And have any of this week's events changed your outlook, or which was for generally softer dollar throughout the year, but I think a difference for many people on what the timing of that might hit?
I don't think so. I think that the events of this week sort of play to the themes that we've set out in our year ahead. Most obviously, that we've become more confident that the turn lower is coming through the first quarter and through the second quarter as well. So that slightly more hawkish slant to the Fed would sort of play to that idea. One of the lead trades that we look for in the future, or moves that we expect, is that the euro dollar does move higher, and so that slightly more hawkish ECB meeting sort of plays to that. But I actually think that monetary policy isn't going to be the sort of key driver of that. It's going to be relative growth, and we've all been focused on central bank meetings this week, but what's the new and important information? Well, it's coming out of China and China's zero COVID policy unwind, which is probably coming a little bit earlier than we expected. And we think that the key theme for next year will be the US economy just becoming less exceptional. So this week is perhaps about interest rate policy and carry, but it's relative growth that's going to be important. And a key part of that is energy prices here in Europe. We're in a cold snap at the moment. The weather forecast, thankfully, is for sort of warmer weather ahead. But if we're right and the outlook for energy prices in Europe is manageable, and that you're going to get some support for global growth from China reopening a little bit earlier than expected, then we think that plays negative for the dollar and supports the idea that both sterling dollar and euro dollar ultimately trade higher through next year. And so this week's events don't really change that particularly so much.
It's an important reminder, and you've said in the past, here and elsewhere, how something that helps a softer dollar outlook is a better global growth environment, and so that's an important reminder, I think, heading into the year that, we're maybe focused on central banks this week, but as we head into 23, what happens to global growth, other drivers, China, relative expectations of growth, which are probably pretty low in Europe and UK and elsewhere, all contributing to that call. So excellent. Thank you, Paul. Like I said, there's a lot of moving parts. That was the story for 2022 as a whole. And for better or worse, 2023 doesn't seem like it will be much different. With that, I want to thank everyone for listening to our podcast this year. Hope everyone has some time to recharge over the holiday season. And we look forward to taking on these and other important topics in the new year. Good luck and see you in 2023.